Welcome to the Gray Report. Exciting week. We're fresh off a trip to San Diego at the National Multifamily Housing Council. That's the biggest multifamily meeting of the year. All the biggest owners in the multifamily industry, brokers, lenders, all in one spot. So we had an entire week of information gathering. I've come back with notes, conversations, stories, but there's been so much else that's been going on this week. Not only was there a Fed meeting, there was a job report. We've got reports from CBRE, Moody's, and the Harvard Joint Center of Housing Studies trying to put it all together. We're at an inflection point in the multifamily industry. The tides are shifting. So we're trying to see how fast, in which direction. Dr. Matt Bosnagel joining us once again. He's put a great report together. We're going to be digging into it, try to make some really smart investing decisions. So if you're a multifamily investor, active or passive, maybe you're in the industry, you're in the right spot, strap in. We're going to have a great episode covering everything related to multifamily, housing, commercial real estate, and the economy. Let's just get into it. All right, welcome back to the report. I said, joined again by Dr. Matt Bosnagel, Director of Communications and Marketing.
Hello.
Here at Gray Capital. We are live in the beautiful Gray Capital Studios, Gray Capital HQ in a slightly overcast Indianapolis, Indiana.
It's all right. It's a little bit better than San Diego, I think.
San Diego, well, we just barely escaped an onslaught of rain. Took off 7 a.m. Pacific time yesterday morning. Just got out before this atmospheric river came to dump water on California.
Yeah.
Barely got out in time. Glad I did. Be back in the seat. Do this with you, man.
For real.
Yeah, it was a little bit of a whirlwind, but I would say that for Gray Report listeners, folks that are listening to the newsletter, you can check it out, graycapitalllc.com/newsletter. If you're listening to the podcast, watching us on YouTube, make sure you subscribe, like, so you can make sure you get updates. But if you are a listener, the information on NMHC probably wasn't a shock, but we want to make sure we're not just like an echo chamber here. We're looking at the same reports and talking back and forth. We got to get out there and talk to a lot of different people. We do that a lot anyway, but to talk to many dozens of owners, dozens of brokers, dozens of lenders gives a really good sense for getting a pulse on the market.
Yeah.
And so a couple quick takeaways, Matt, and then we can just get into everything else. This is going to be a long...
I've got one question before you go with your takeaways in terms of the way that people kind of present themselves at NMHC. I think that it's a place to gather and listen to people, the knowledgeable people share about the industry, but also a place to strut your stuff a little bit. And was there a little bit of filtering or was there optimism, pessimism, or could you kind of see past some of these?
Well, all the brokers have been sat down in a room in their respective national meetings, and optimism was definitely getting drilled down. Because is there any other path forward?
No.
Besides finally being able to do some deals this year and volume picking up. The biggest difference, there were a lot of differences between this year at NMHC and past years, and that was the amount of deals. Typically, brokers use NMHC as a launching pad for their offerings and their deals for the year. So you sit down with a broker, and you sit down, oftentimes they've got a sheet, and it's got 20 different properties on it. And these 10 they're on the market as of today. And these 10, they're going to be on the market over the next quarter. And so this is what we know is going to be coming out. And I'm going to tell you, and they'll say, I'm going to tell you about these other deals that aren't on here, but should be coming out, should be a good fit. What looks good? What are you interested in? I don't know how many conversations I had with brokers where it was just, we don't have anything.
Oh,
nothing.
Different this year than last year?
Yeah, last year people had deals.
That's
people
so
still had
interesting.
deals. Because if you remember last year, beginning of 2023, the stock market hadn't been doing that
people
great
were
in
freaking
2022.
Yeah.
But people weren't freaking out just yet. The 10-year treasury was like 3.5%.
Yeah.
Rates were high, but they had not gotten really high. The pain hadn't been turned on. There were concerns, but there was still this idea. There was misplaced optimism of that. They're like, I think rates are going to be coming back down.
Yeah.
Like in middle of 2023. That's not happening.
Yeah.
But it was much more, I would call it business as usual.
Okay.
It was also after a period of record deals, record volumes, and record profits for owners, brokers, lenders alike.
Yeah.
So the parties were bigger. There was definitely more pomp and circumstance. And
this was
last year, 2022.
In 2020. Okay, for 2023.
Sorry, beginning of 2023.
Yeah.
But kind of reflective of how the market had been in 2020.
Okay, that's really interesting. So it's a reflection more maybe of the previous year.
Yeah, exactly. It's much more reflective of the previous year. Obviously, you're looking into this year. And this year, everyone kind of wanted to put 2023 behind them.
Yeah.
It's like we didn't really get to do many deals. It's a tough market. But distress not showing up as much as people had thought. Banks, I talked to a lot of banks, a lot of different lenders, a lot of extensions, a lot of modifications. It's kind of generally understood that a lot of bridge lenders, they are modifying. They're kicking the can down the road for as long as they can.
Yeah.
That's going to probably work out for some folks, maybe not for others. But no one wants to realize some of these losses and some of the pain right now when they think that there's a chance, maybe a hope and a prayer, good chance for others that rates are going to come down a little bit or performance picks up and there may be some more optionality in a couple months or in a year. And so instead of having to take the keys back, let's just give them another year. And we can, that also allows the lender to maybe they don't have to kind of realize any losses either. So it's there's some shared goals kind of in that strategy. It's not a lot of deals, but man, everyone's looking for deals. Everyone wants to buy. There's a lot of money that was floating around, looking for opportunities. Everyone is looking for a deal. There's just no deals that are really available, as I mentioned. So it was, I think everyone was trying to figure it out. Hey, what are you doing? What are your plans for the year? How are you making things work? And a lot more matchmaking that's being discussed as opposed to like, hey, like I said, here's the menu of deals. It's more of like, tell me more what you're looking for. Maybe we can go find it.
Okay.
And I'm gonna go find a particular deal. We're gonna just put this deal together. We're not gonna go through the whole effort of actually marketing it or anything because it's a lot of time and effort that goes into that. And if it doesn't work out, it might not be worth it to the brokers themselves. So really interesting conversations. One of the things that I thought, Matt, you'd just be absolutely interested in, and everyone should be, was I attended a panel discussion or a conversation that included Jeff Adler from Yardi Matrix, as well as Jay Parsons, the chief economist at RealPage. A lot of the folks listening to the Gray Report, if you're in the multifamily industry, you're probably familiar with both of those names, especially Jay Parsons. He's one of the leading thought leaders, I'd say, in multifamily, especially that's like an economist and putting out some really good research, really good data.
We love him.
Yeah, he's great to follow on LinkedIn and social media, puts out a lot of really good stuff. And there is a disagreement. Because Yardi and RealPage both are prolific publishers of multifamily data and research. And there is a pretty big discrepancy at supply. We've talked about, right now, it looks like supply in the multifamily industry, while it's going through a record delivery right now, 36-year high, basically it's going to fall off a cliff sometime the latter half of 25 and 26. Both Yardi and RealPage agree that there's going to be a reduction in supply, but there is a pretty big difference between Yardi's opinion of how supply will be reduced and RealPage, with Yardi thinking there's going to be still some substantial supply going through 25 and it'll become more moderate in 26 versus RealPage's outlook that supply is really going to drop off materially at the end of 25 into 26. The big difference in opinion is Jay Parsons of RealPage is basically saying these development deals aren't getting financed. Yeah, they're trying to do it and they're projecting to do it. They want to. They're looking for the financing, but they're not getting it. And so if you're looking at Yardi's looking at proposed projects. And Jay Parsons is saying these proposals aren't getting done.
Yeah.
Maybe they're going to get done in a couple of years afterwards, but they're not all getting done. Some, sure, give you that, but not nearly as many as you think. So that's the big discrepancy.
Is that like marked by permits? So if you want to track permits, would that be a good indicator of the starting line that Yardi Matrix is measuring?
Well, and Yardi Matrix is going even before permits. They're looking at going at like kind of planning phase. They have a couple other stages prior to even kind of permits and starts.
Okay.
They like permit starts, like plan and like inception.
Yeah.
And there's over like 3 million units that are kind of like in planning phase, but a lot of those never get built.
And I just did like back of the napkin math a week or two ago. It showed that like permits, the number of permits, you go 2 years later, 30% of that number ends up in completions.
Exactly.
So I don't know.
I think, but that's exactly what Jay Parsons is pointing to.
Yeah.
So really compelling. The other thing, the big difference from previous years, the Midwest was actually mentioned.
Oh, wow.
In previous years, the Midwest is a footnote that hardly gets mentioned, and it gets mentioned in the context of like Chicago exists, and then they'll use Detroit as an example for the rest of the Midwest or Cleveland. I'm like, oh, come on. Jeff Adler actually said some of Yardi Matrix had some really interesting things when they were talking about the Midwest, specifically about Indianapolis and Columbus, Ohio, and talk about Kansas City as well. But Indy and Columbus kept coming up, and he basically related to. He said, you said Nashville, Tennessee. Everyone wants to be in Nashville right now. Austin's blown up. It's been blown up as well. Both markets are being oversupplied right now. He goes, Nashville wasn't a thing 10, 15 years ago. Austin really wasn't a thing either. They were both markets that everybody knew and they were good places to live, but they were relatively affordable. And the dynamics of those markets have changed considerably. He goes, it would not shock me because there's a similar setup for markets like Indianapolis and Columbus. Not necessarily going to be like the next Nashville or Austin, but to have similar growth trajectories in that there's a paradigm shift for the demand for manufacturing, reshoring, all of these jobs that are coming out of Asia or elsewhere. They need to find homes in the United States. Indianapolis and Columbus has already been winning these jobs for the reasons that it's an affordable labor pool. The labor is plentiful and it's reasonably priced. There's affordable housing in these markets. There's available water in these markets, low taxes, business-friendly environments. There's a lot of just blue ocean. There's room to build in these markets. The the location of these markets make them ideal for logistics, for shipping out. That's why you're seeing major chip manufacturers make announcements in Indiana, in Columbus, Ohio, battery plants, e-manufacturers. We're seeing it right now, man. Kokomo, Indiana is an example. It had been a market that had a lot of auto manufacturing over the years, went through a period of some declines over the last kind of 2 decades. There are plants that are being retooled, making EV parts, making batteries. They're adding thousands of jobs. That population growth has absolutely done a 180. Now it's growing. We're seeing similar trends in other Midwestern markets of where there wasn't really anything going on. Now, these large manufacturing bases are coming back. Look at a market like Columbus or Indianapolis that not only has that ability to be a strong manufacturing base, but also has a very diversified economy, universities, healthcare, hospitals, state governments, and both Columbus and Indianapolis have other sectors as well. It has biolife science with Eli Lilly, advanced manufacturing, Defense Department stuff with Allison Transmission and Rolls-Royce. So a lot of just different dynamics that make the Midwest and Indy and Columbus really interesting for a setup for the next 10 years.
Yeah, that's really interesting. I think back to like SimCity. The jobs come in from the industrial.
You got to have it.
You got to have that. Well, jobs. And I knew even playing that little video game that was oversimplified just to say industrial brings jobs, but manufacturing base is a huge powerhouse for an economy, and it's hard to find any area of the economy that's bigger than that. Even information and business stuff. The real numbers are coming from manufacturing. And this reshoring, I'm very curious to see if the pandemic's over. Is this reshoring effort going to continue? For all these plans that were set in motion, they're going to happen probably. So,
well, especially on like the chip, I mean, big drivers are EVs, electric vehicles, batteries, but then also chips. I mean, basically, we all realized that we had a major national security problem having almost all of our semiconductors being manufactured in Taiwan and China.
Okay, that makes sense.
And mostly Taiwan. And if China invades Taiwan, we have no chips.
Okay. So
it's a national security.
It's not just like a shipping container thing.
No, it's not just like, we'd like to get the widgets here a little bit quicker. It's like the country won't work we'd have a potential adversary being able to it'd be like the oil. And another SimCity reference, Matt, actually semiconductors were a resource. Like oil at some point in the new SimCity that came out.
All right.
Kind of, Anyway,
I'm glad you got my reference originally, though. But that's really interesting, though, and it gives me a little bit more optimism for the growth of the region. When I was looking over just some of the data from these reports this time around, some of these Midwestern cities they don't have the population growth of Nashville. Indianapolis is not growing like Nashville at all. But the real story for me is like how much apartments are being dumped on Nashville and versus the steady stream, I guess, for Indianapolis, but not nearly as much as the flood in Nashville, the figure of flood.
Well, and that makes sense. I mean, because the job growth is a leading indicator of population growth.
Yeah.
So it makes sense. But I mean, I remember, Matt, when I was looking at moving back to Indianapolis, I was thinking about moving to Nashville. It would have been cheaper at that point. This was like 2013-ish. The housing was cheaper in Nashville than it was in Indianapolis.
That's really interesting. The fact that
and it had been like that for a long time. It was just like, sleepy Nashville, Music City.
I think of like on the neighborhood level, how long it takes for like a submarket or neighborhood, just in Indianapolis, just to kind of take off. It's like, oh, we were waiting for that area to take off, and then it does. But a whole city can turn around sometimes. It seems like 5 to 10 years. That's crazy.
Yeah.
And I think it's really promising for the Midwest, which again, I thought the story was going to be unexceptional growth, middle of the road growth, but the apartment supply situation makes it a very attractive investment. But yeah, we may be getting the best of both worlds for investors.
Well, right now. A lot of conversations around the Midwest, around Indy. Obviously, opinions of the Sun Belt's going to do really well over the next cycle as well, as most have thought, and as often is priced in to your cap rate that you're paying in many of those markets. So really great to meeting with folks, spending out time in San Diego. Just a couple of, insurance markets apparently are stabilizing. Sounds like they're still going to likely increase, but maybe not. We're going to see the dramatic increase. I mean, insurance, especially for folks in Florida, Texas, and any of coastal markets. I mean, it's been a critical issue. I mean, it's gone up, 5 times for those over the last couple of years. And that can be pretty unsustainable.
I had a question about back to the buying sentiment. It's just so what about the selling sentiment?
A great question.
Was anyone complaining about the bid-ask gap, or what? Did anyone speculate that, we've got 2 more months of price declines, or what? What's the attitude towards brokers? Are they like, we're going to sit on this price for a little bit, but I'm not really have a lot of faith in it. Like I'd wonder what the sellers are thinking.
Well, there's not a lot of sellers, so
the 3 of them.
So there's that, but. No, I mean, the broker's opinion is that we're basically at the bottom, and they're not gonna ever say that, hey, no, we're not there yet. And I think and I'd agree that, we're pretty close to we're in the zone.
Yeah.
We're in the zone where I think it's a time to be buying right now because there is so much money that's on the sidelines looking to get into the market that I think there's a floor on pricing.
Yep.
Unless it's just an asset that absolutely nobody wants. But in general, like there's so much interest. And the longer term fundamentals past 2025 are really solid, and people are looking to get into the market. And so the spread is there. It sounds, honestly, it's like cap rates seem like they're in a good spot. Values seem like they're in a good spot. It's just, it seems like we need interest rates to come down a little bit more.
Yeah.
Now, if interest rates don't come down a little bit more, then that could lead to cap rates expanding a little bit. But the treasury rates are down slightly this week. The 10 years below 4%. It was 3.88 yesterday. I haven't checked it today. Sure, J-Pal, there was a Fed meeting this week, Matt, that I took a lot of notes on. We can talk about it if we've got the time today.
Yeah.
And we're not sure on the timing, but we're pretty sure on the direction. I mean, they basically said, J-Pal said on Wednesday, we are highly confident, and we're at the peak of this hiking cycle. Like it's not getting worse. And so what's the timing like? Almost certainly we're not getting a rate cut in March. Basically, so they need more data. And basically he's like, we don't need better data. We just need more data. We just need to see a continuation of the trend of moderating inflation, normalization, and what he refers to as healing, economic healing.
I love that.
Yeah, no, he mentioned it multiple times. I underlined it 3 different times. And he also said rebalancing, but healing, normalizing. And I didn't put this in quotes, but this is so kind of what I inferred what he was saying is, and really with their opinion, is that it's so much of this has been just the demand shocks and supply chain bottlenecks that were so extreme and caused extreme inflation. And this normalization is what could potentially facilitate the soft landing in lieu of a real deep recession or destruction of employment and a destruction of the housing market.
Mm-hmm.
He came out a number of times, Jerome Powell did at the meeting this week, and he said, I'm going to just say I'm paraphrasing. I have quotation marks, but housing is not in our mandate, is what he said.
Yep.
He's they're not interested in targeting prices, on targeting houses. They're not interested in the cost of housing, et cetera. Although he said home ownership or access to housing would be a good. And he acknowledged cutting rates is gonna help housing, and also unemployment. They would very much like to see unemployment stay low. They don't want to see unemployment go up, and I think that they believe that there is an opportunity to not wreck the economy, not to cause joblessness, and to increase unemployment in order to get inflation in check, because inflation is in check, or it's trending in the right direction. And so it's like, if we don't have to, let's not. And I think, and I believe that Jerome Powell believed, as I believed and many others did, that in order to get inflation in check, you do have to kind of wreck the economy. You have to smash the glass.
Because every good jobs report, everyone's like, no, this is actually bad. But yeah. Interesting.
So I think that they're of the opinion now of like, hey, the economy is good. That's a good thing.
Yeah.
And inflation's coming down. That's a good thing.
Okay.
We're looking at our 2% target inflation, which may mean we need to get below 2% for a couple of periods in order to get that average. But what I really took it as like, hey guys, we're almost there. Let's just be patient.
Yeah.
They think not just like they have a longer term outlook, and the market needs things to happen now, and everyone wants it to happen now.
Yeah.
And what I got from Jerome Powell was like, look, we're gonna get there. Like, we're almost there. Just like, let's just come the way we need. And because the balancing of risks of cutting too soon could cause things to get hot again. And as we saw, you mentioned the jobs report that came out today, Matt. I think 387,000 new jobs were added. I'm sure it'll be revised down. The estimates were like 180,000 jobs. So, I mean, that's good for the economy, assuming we're not getting into a wage price spiral. It sounds like we're going to be in a higher rate environment than we were in the last cycle, but it's not going to be crazy high. I think it's going to be relatively moderate. I think we're going to have, I think if inflation is running at 2.2, that's okay. I think rent growth is probably going to be running average of 4%, maybe instead of 3%. The other thing that Jay Parsons said, Jerome Powell acknowledged as well, on wage growth. We're seeing really good wage growth. Jay Parsons said, and listen to this statistic, he's 99% confident that wage growth will outpace rent growth again in 2024.
Wow.
Wage growth outpaced rent growth in 2023. And so with another year of wage growth outpacing rent growth, we're kind of going to get back to the affordability levels we had a couple years ago, which admittedly didn't seem that cheap to people renting an apartment, but rents never seem cheap, I guess. But it will be statistically more affordable than it is today. And with the housing stock where it is, it's still going to be relatively difficult for the folks to buy homes, although a little bit easier for
when Jay Powell was talking about housing, was he acknowledging the fact that at least rental housing is beginning to come down, the prices?
Yes, he did. And I can look for my quote, but he absolutely mentioned that. He said, we know. He says, we know that's going to start showing up in CPI. The rents are going to decline because we know the market rate data. It's going to start coming into the system. He goes, it's a matter of time. He's like, we know this. I'm glad you brought that up, Matt, because another comment that he was asked about some of the data that they look at. During the pandemic, they were looking at a lot of more unconventional data and more real-time data, like open door dinner reservations and stuff like that to track the economy, because they didn't necessarily have as much access to some of their traditional research and surveys, because they were all like government workers that weren't working.
That's funny. I was looking up a bunch of stuff. There is, in so many census things and BLS things, there's just a gap during the.
So they had to use these other methods. Now he said that they've stopped looking at a lot of the kind of, he called it innovative data sources. It sounds like they do look at it, but they are utilizing their kind of traditional methods and data much more primarily than some of the more real-time private market data, which can be here or there. But They absolutely acknowledged that, like, look, rents are down. We know that market rents have been down. That is going to start showing up in CPI. Just not really sure when, but we know that is going to happen. Yeah, for sure. So so a really fascinating week of data and information. Yeah, between being at NMHC and then talking to so many folks.
Yeah, even just gathering the articles and stuff that I ran across for the newsletter and even on Sunday, it did seem like a common theme formed for me just sitting at my desk, and how much, and you mentioned this too, it was this longer story of housing supply and also really demand from investors and demand from renters. How are they how many people are going to rent this coming year? How powerful? And a lot of times people say the affordability crisis, that can be roughly a proxy for people are demanding houses, and that is making the price of that go up. Yeah. And so it is still a crisis. And the Harvard study will show that it's a crisis on the lower income range. But even then, at all levels, we can't fill in the need for housing with even 2 really great years of new apartments being built. So that's something that bore out on multiple reports that were out recently.
No, that was confirmed at NMHC also, is that, like, look, we still have a major housing shortage after this. Like, we're not built like we're not going to be, we've got 1 million units under construction. We need like 3 to 4 million. And then we're getting ready to stop in 25. So we're going to go into a further deficit.
This is jumping gun a little bit, but this story of housing, and it is a much bigger and longer term story. The trends that we're talking about with housing demand, much more than the pandemic. It's a bigger.
Yeah, no, I think good point. Well, so Matt, there was a piece from CBRE. You just mentioned 2024 U.S. Investor Intention Survey. Investment activity expected to increase. Now, this is great piece because it really lines up with a lot of the anecdotal data, our conversations that I've been having with capital allocators, investors. Time to get out the sidelines and start making some moves. Yeah, it lines up with my idea of, like, look, this is the time. I don't know if we're at the bottom of the market right now, but now's the time to start buying and making some moves. Yeah, just bring us right in.
Headline
Tell us
numbers.
The CBRE report.
So this is just a survey of investor intentions. So what percentage of people think and that they will increase their buying by over 10%, by up to 10%, by none at all, and then how many will decrease by over 10 or up to 10%. So those things, are you going to buy a lot? Are you going to buy a little? Or are you going to buy not at all? Or the same? And they have a few graphs on this page, but I also made my own graph.
Is that Monument Circle, Matt, on the front page?
That could be. Yeah, I think so. That is Indianapolis, right? We'll have to go double check.
I mean, I'm pretty sure that's Monument Circle.
I don't think it could be anything else.
Yeah, that's the that's the MS building, and so
all right.
Oh, do you see the church? Or is it that? Yeah, right there.
Well, there you go. We have made Indianapolis has made the.
Did I tell you, Matt? So they did like a Young Guns pitch where like they pitch a couple different fund ideas to an investment committee. A fund based out of Indianapolis, theoretical case study. That's what one was, going in buying stuff in Indianapolis, the Midwest made the most sense to the
nice. That's great.
Yeah. Well, so sorry, bring us in.
It's in the atmosphere. So the answer to all these questions. So they ask, are you buying? Are you not buying? 40% intend to increase their buying by over 10%. 20% expect to up their buying by 0 to 10. 25% think it'll be about the same. So sum that up, about 60% think they'll increase their buying. Now, when it comes to sales, it's very similar. More people intend to sell than to buy. More people intend to sell than not to sell, but it's a little bit more muted when it comes to people intending to sell. That being said, if you compare this to 2023, nearly 60% said they would buy less. And over 50% said they would sell less or the same amount of properties as the year prior. That is almost the complete opposite of this year. So we are really in the reverse. And frankly, 2023's investor intentions report last year, it came true later in the year. Yeah. So this could come true. Now, I always think that people are a little more optimistic about how much buying they're going to do, but
what they would like to do.
Yeah.
And that's, I think everyone has intentions to buy a lot, just what the opportunities are going to look like. And then again, that's what leads me to believe that there's a floor on pricing. Prices can only get so low because of how much interest there is in the few amount of deals. Same thing with the single family home market. It's like, oh, everyone says prices should decline. It's so hard to get a mortgage. It's like, well, there's only like 3 houses on the market.
I was going to mention this in another report that came this week that we just didn't have time to talk about. It was the Marcus and Millichap had their voluminous multifamily forecast report. And they talked about how there is a group of buyers and sellers, group of investors that really haven't been around the block for long enough. They lived in low interest rate land. And the people that came before, where the pre-Great Financial Crisis, the people that were used to the high interest rates and maybe a little lower rent growth, those are going to be, the implication was those people will survive. And the people that were used to easy free money and big high rents, those people will wither on the vine. That may or may not happen. It also precludes the possibility that people can change or react to
because all the people that were in the last Great Financial Crisis were all doing riskier things.
And those same people were doing. Yeah, so I have a feeling that people are going to change but whatever. But
I think this will teach a lot of lessons for those. Yeah, I think it will thin the herd. For sure. Mm-hmm. And those who get through will have learned a very valuable lesson.
But I also think that let's say that there are more people that have higher expectations coming in to invest.
Yeah.
That's going to change the character of the market itself. Just the fact that this population is made up of different people that are more excited about investing. So that's going to maybe lower cap rates a little bit than if people were like, well, we expect X and Y and Z, and this is how the old ways were. But the composition itself, whether they're right or not, if a lot of people think that something's valuable and they bid on it, then that goes up.
And the quasi-institutionalization of private markets and alternative investing is also, that trend has been increasing significantly over the last decade or so.
Sure.
I speak with RIAs all the time, wealth management companies who traditionally have offered services to help manage public portfolios, stocks and bonds. And more the ones that have grown a lot recently are the ones that have also created a focus on alternatives and offering alternatives to their clients as a way to differentiate themselves from others. And also acknowledging that alternative investments, private investments, including but not exclusively real estate, is I won't say it's essential, but near essential and a critical part of anyone's portfolio when considering portfolio construction due to the uncorrelated nature of many alternatives that aren't traded on public markets.
Yeah.
And so there's the whole idea of stocks go up, bonds go down, stocks go up. And you're kind of always going to be okay. Well, they don't always interact like that. That's often the case.
Yep.
But adding real estate, bonds and kind of stocks have changed their behavior over the last several decades when a lot of this kind of portfolio theory really was written. But even looking just at kind of modern portfolio theory and other types of portfolio construction theories, adding alternatives, adding real estate can de-risk your portfolio significantly just because the correlations are different.
Yeah.
And the return profiles are different. And you can do really well. Now, there's liquidity issues, but that's okay for if you're an ultra high net worth individual, that's fine. And so getting back to what I'm saying to you, I think you're actually absolutely right. More people are getting into this asset class. Again, it was just 2012 when that Jobs Act was passed and allowed for kind of crowdfunding, 506B syndication, 506C syndications, the public solicitation of deals, which really didn't kind of pick up. So people didn't really know how to do it up until the last several years. So more people are aware of the idea that you can invest in an apartment, a big apartment community, which like that, how did you do that?
Yeah.
Like 5 years ago, when I got into this business, Matt, 5 years ago, it wasn't like an easy thing you could just go do. You couldn't search like apartment syndicator. Like no, that wouldn't show up. There weren't like crowdfunding websites weren't even a thing yet.
Yeah.
And that was like not that, that was like 9 years ago, 8 years ago.
Yeah.
So a lot has changed and just that knowledge, because even if you're not
You just forgot the pandemic, by the way.
But
he said when I got started, I got started 5 years, like, well, no, like 9. That was funny.
Well, first started getting into multifamily investing 9 years ago. And then, but the knowledge base, I got a text from somebody, like a cousin, Alex's cousin, and he was like, hey, I want to learn more about this stuff. Like, it was like yesterday.
Yeah.
It's not just like something that you can do. People are realizing that it's something I really should and need to do.
Yeah. No, that's a good point. And just to kind of close out this coverage from CBRE on investors' intentions. Now, the CBRE report covers all of commercial real estate, and it wasn't just multifamily, but they do talk about their hot markets.
But I can tell, but if you're thinking about buying commercial real estate, you're not buying office buildings. You're talking about multifamily and industrial.
Totally. And I think that actually bore out I don't have the numbers in front of me, but I think that was, they said it in the CBRE report. That's top sector. Top markets, though, are Dallas-Fort Worth, Miami, Raleigh-Durham, Atlanta, Nashville, Charlotte, New York City, Phoenix, Tampa, Austin. Really the Sun Belt, really hot markets. Nothing surprising except for maybe Boston as one of the top markets for total property returns.
These are just like surveys. So this is like where people think the returns are going to be.
That's what I think so, yeah.
And these are probably the places where they're investing or live.
That's right, yeah.
That's what it looks like
because the only discrepancy between the predicted returns and the prediction of investment was swap out Boston for, I don't know, Tampa, I think. Well, just let's swap out Boston for Austin.
Phoenix.
Yeah. Oh, yeah, that's what it was. But anyways, roughly the same. Sun Belt plus New York City and Boston were the ones that they were paying attention to. And they predict that so that's kind of where the investment may happen. But when is H2 2024. And now I'm going to, you notice me glossing over the where of these, of like the hot markets, because I think it's a little different when you're looking into a specific sector, and the specific performance of a lot of these markets may not be as promising as some people, as you know.
Again, I think it's probably a little bit self-selective bias, but no, I do agree. This H2 2024, I think everyone has a second half of the year earmarked for a lot of activity.
Yeah, and CBRE actually does close their little report by talking about higher activity in H2, and he says that CBRE concurs with this view as interest rates fall and financial conditions stabilize. So they're kind of speaking for the company, which is nice. Although I will take this moment to say that my thoughts are mine and mine alone, and are in no way representative of Gray Capital as a company. However, the views and opinions expressed here are mine and mine. Oh, yeah. Did we ever show this picture?
No.
All right. Well, this is a good picture, and it does represent very easily, just at a glance, the difference between 2024 intentions and 2020 and 2023. 2024, they want to buy and they want to sell more. 2023, they want to buy and sell less. And it is almost a complete opposite. Like, you can't get more perfect than this. And I wonder if that's a little bit contributed to the vibe at NMHC, but
I don't know. But no, I think it was there a little bit before, just more confirming.
Yeah.
Okay, man, this next piece from Moody's: one good year does not solve America's housing shortage. We were just talking about that earlier.
Yeah. Even though multifamily, what did they say? Multifamily completions increased by 11.1% sequentially to a seasonally adjusted annual rate of 509,000 units. At the same time, household formation, choice of location, etc., they finally reverted to normal. So one good year of excessive supply was only in its relative term when compared to affordability-constrained demand. There is a long way to go before solving the chronic housing shortage, but asking rent reacted with a modest decline. That's still, the point of this is that we need more housing in the country, rental and otherwise. They illustrate this with a graph of housing completions by year, and it bothers me a little bit that the graph doesn't go up to 2023, but I can tell you that the number for 2023 completions is 1.5 million units completed, which is above the 1.1 average of pre-Great Financial Crisis and Great Recession. But as Moody's explains it, after that housing crisis in 07 and 08,
there wasn't a million units completed this year. That's what's under construction. I think it's like 400.
Maybe it's
400 some thousand. I think.
Okay. So I'm sorry. Yeah, I had miswritten it here, but 1.5 million under construction, and after the housing. So average units built after the housing crisis in 2008 were only 765,000. So we may be above average for new housing this year. Maybe we will be, and last year we were, but we're still catching up. And as the report really puts it, rather boldly, strongly, whatever, it is important to emphasize that preserving and increasing housing stock to restore a more balanced market will require many years of joint effort and creativity from both public and private sectors. The cost of land and access to construction financing are key factors to consider. Yeah. I have heard, maybe it's because Matt Baxter is looking for land, but I keep hearing about how land is a finite resource, and a lot of people are talking about that as
making any more of it.
They are making any more of it, but sometimes I think
something to buy.
Yeah, just clear out that field and then we'll build there. It's in the right location. And I think that it is worth noting that they still say that financing they don't speculate specifically on like a solution to these problems. Neither Moody's nor, in a second, the Harvard Joint Center for Housing Studies really go hard on, all right, this is what we need to do to solve this problem. We need to do X, Y, Z, and then this is going to happen. They more really call attention to the problem with a lot more rigor than they do potential solutions. However, implication is let's lower interest rates. Or I think the other implication is let's lower regulations so that more types of different land open up and are able to be built on. You can build an apartment there.
In San Diego, obviously California, horrible housing crisis. I mean, I saw, we saw people OD on the way to the conference, Matt, literally.
Jeez.
But one of the reasons why they have such a bad housing crisis and housing affordability crisis is because the restrictive zoning laws. And there was a lot of conversation, and we're not investors in California, so I paid attention. But it's, if you can't build, you're not going to be able to add to supply. You're not going to be able to continue to stabilize rents. And then there's a lot of data that's been coming out showing how even new construction of luxury apartments can put downward pressure on even C-class rents and B-class rents in some markets. It doesn't always work. It does not always work out that way, depending on what the supply and what the demand is. But the key to the housing crisis is more housing. It's not a convoluted system. There's a lot of talk, Matt, about this middle income tax credit that may be coming, I don't think it's actually in a bill yet that's going anywhere, but it's a popular proposal, the low income housing tax credit. It's basically been the way we've been able to build affordable housing in this country over the last, couple decades. But as we can see, there's not nearly enough affordable housing. And it's not just the folks at the very bottom of the spectrum. It's some of the folks that are kind of in that middle range also, not like middle class, like true middle class folks, but so coming into a new type of tax credit that's more lower middle income, not just very low income. It could be part of the solution, but we got to build. We need market rate. We need tax credit. We need the rest of it. That's the solution. And to you were talking about, it's because a lot of localities have restrictive zoning law.
It's funny. It's not zoning laws. It was an article on, I think it was rent control, and I forget specifics. I forget what the source was, but their points on the issue was that rent control, it benefits and it reduces mobility, and it pretty much locks out apartment supply. So there's a lot of negatives that kind of build up when that's associated with rent control. And it may have been in the Harvard Joint Center for Housing Studies, just in a separate report. However, you think about that, right? The people that find that apartment, and it usually benefits older people because they've stuck around there. They're realizing those gains. So I don't know how sticky rent control laws are. My guess is very sticky, but
they're all so different because they can be local.
I have a lot more hope though for regulation, kind of clearing up regulation and allowing people maybe to build an accessory dwelling unit in their backyard,
which has been a very popular strategy that they're doing in California and San Diego. There's a lot of ADUs that have been going in. Yeah. So let's talk about this JCHF, the Joint Center for Housing Studies from Harvard University, Matt. So again, because so much of the piece that we look at, they're from like the multifamily industry, market rate, kind of driven by investors, for investors. We're making money. They're different angle, different perspective, much more. If anything, they have bias in the opposite direction. Probably more.
The problem for us is we aren't making enough money, or
they could care less about investors making money. They're just looking at the issue of housing.
They're more like people are spending too much money on housing. How do we make it cheaper? And a lot of times, our motives as investors can definitely align with, and I think it may work best when it's aligned.
It 100% is. And this is what, Matt, you're gonna make me go on a little bit of a
yes.
The interest is aligned.
Without
the investment into housing, whether that's new inventory or the maintenance of existing stocks, you're going in, you're maintaining a property, you're fixing it up, you're doing a value add, which sounds evil. But the alternative of not doing that value add is these properties falling into disrepair in conditions where people shouldn't be living in, and then eventually goes offline and gets demolished, reducing supply, increasing rents for everybody else. We need investment into housing, into all types of housing, in order to keep rents stable and affordable. Raising rents a little bit here, while seems like, okay, you're going to be hurting the renter in the short term. If we can only achieve that by adding value and adding value to those communities by fixing them up and maintaining. Think about it as maintaining the housing stock.
Yeah.
What does it take to maintain a housing stock? It takes money. It takes investment. And if there's no incentive at the end of the day and no return for doing that, no one's going to do it. The government's not going to do it. Even if they can't, if they wanted to, and said they were going to do it. So it's on us as investors. So people can say for market rate reasons, for capitalistic, selfish reasons, we want to invest in housing, and we're going to make money doing it. But we're also creating affordable housing, and the long overall impact of more investments in housing is a more affordable housing market and more supply for renters. Now, there's bad operators out there that aren't adding value and are extracting value from people. And are deadbeat landlords. Screw those people.
Well, and there's also a little bit of a difference in just like the business plan of affordable housing and in market rate housing. A lot of what we're talking about every week is the market rate housing world. What RealPage tracks, the market rate housing world. What Harvard is talking about, a lot of it is affordable. It blends. It does not make as much. It will talk about the distinction, but a lot of times they just group it all together, all rental housing. So.
Exactly. So
their takeaways.
Apologize for the quick rant, Matt. But people look at, you guys are in the apartment business. You guys are the ones raising the rents. Well, you know who's responsible? It's the Federal Reserve, Jerome Powell, and it's every ordinance that prevents someone from building a house. Those are the people that are raising rents by 20%, 30%. It's the Federal Reserve keeping interest rates at zero for months longer than they should have been.
It is. And I've said this before, it's interesting. Yes, sure, it is a little bit of landlord, but it's also like a commodity. You can go on apartment list or apartments.com and you'll find out, you look at the similar apartments and you'll find they're all, hundreds and hundreds of buildings. They're all about the same for the same price. It's not, there are some opportunities out there, and that's what we're looking for as investors. But again, it is like there's a lot of fish in the sea, and to point at one landlord and say he's making the market, I don't know that. I don't think that works.
Market wouldn't support it.
No.
All right. So Matt, let's get back into this JCH.
Yes. So they have 6 takeaways here, and then if we can jump to the actual report, which is in the next tab.
Okay. We'll do the takeaways first.
Yeah. The takeaways are, here's 6 of them. 1, rental markets are softening. 2, affordability is worse than ever before. 3, housing instability is rising. 4, rental assistance falls far short of the need. 5, the rental stock has...
I know,
I'm skipping. 5, the rental stock has significant investment needs. And 6, high interest rates are dampening rental market activity. Again, not going to cover all of those. I did want to comment on a couple of them. The first point on softening rents, not really news to people who've been following market rate rents. But the second takeaway on declining affordability is an interesting indicator. First of all, we talk about wage growth growing and rent to income hopefully going down a little bit, but it is a reflection of so many different things, this affordability, including the continued need for new apartment supply, particularly apartments on the cheaper end of the spectrum that you just described, economic factors like wage growth and inflation, and really like the end of pandemic relief measures, which is one of the quotes that they said in there. They all play into affordability, although the numbers on declining affordability may be, like I said, different for market rate apartments. So it is kind of interesting to see that. And I don't know, they don't really pose like a airtight solution, but they say, this is going to be a problem for like C-class apartments. And I know you did mention that new A-class luxury units coming in. They don't usually build them C-class, but the new units coming in, maybe they will have an effect and lower the price of B units. Then the B units will get cheaper and they'll lower the price of C units. I don't know if that's dipped down yet.
RealPage has a slide somewhere, and I'm going to get a couple of slides from NMHC, but they may be on a publication we looked at earlier. Basically, it shows in markets, it looked at rent growth in markets with certain level of supply relative to inventory coming online. In markets that had, I believe, over 6% of new supply coming online relative.
Oh, I kind of remember this threshold.
They showed rent growth broken out between A, B, and C. And in those markets, everything was down, and B and C were down quite a bit.
Okay. All right.
Versus markets that did not have as much supply, it's much more moderate.
Okay. It does make sense. It cascades down, and there's no way that it would increase apartment rents. Although I don't know if it's in the Harvard or some other article I read, there are some people that think as new apartments come in, they're gonna make rents increase. There it is like this.
Well, that was and that's probably a story, an article, and a study for next week, Matt. But that's a really interesting piece. You got to talk about it at NMHC.
Oh, really? Okay, all right. So I wasn't.
Well, I think I sent it. I think I sent
maybe
it,
you did.
I sent it to you like as I was watching, listening to the speech. But the misconception of the idea that some people absolutely believe that a new luxury apartment is going to make rents in the whole market go up.
Yeah.
That's just what people think, and it's not necessarily the case. And I think NYU did the study.
Okay.
I want to say, but really interesting.
Yeah. 5 and 6, which cover the need for additional investment in this Harvard report, that really is our key element, I think, that nicely complement the reporting from Moody's Analytics. And I'm glad that you're kind of jumping into the report here. So on page 4 of the PDF, there's a graph that talks about how apartment demand has started to rebound. They say that, and this is another thing to note here, is not only has apartment demand started to rebound, but the rental stock is older than it's ever been. The median age was 44 years in 2021, up from 34 years 2 decades ago.
Wow.
So we just haven't been keeping up with the buildings. Now, I think that may flow with the population, but still, there are some markets where you could have a net deficit of apartments. And just because they're demolished or whatever, these buildings don't last forever. So it's really interesting to see. And kind of moving on their commentary on higher interest rate covers similar ground. As we discussed on Gray Report, costs too much to get loans, but it's also apartment prices haven't come down enough maybe to make people interested in buying apartments with the high property and interest costs. That's a direct quote from the report. So they're kind of acknowledging where the investor is playing a role here.
Yeah.
But to kind of shift to demand, on page 11, they talk about how rental demand is returning. And I appreciate that this report notes that rental markets are softening. And then, now we're at rental demand is returning. One of these indicators here is a generational one. And it talks about how there's this line graph here, and it shows Gen Z is on the rise. Now, millennials, it says that rental demand has shifted from millennials to Gen Z. Well, really, the acceleration, the growth of the generation is bigger for Gen Z renters than millennials. Millennials are hanging out as renters. I would have to expand this graph out. It looks like millennials are hanging out as renters for a lot longer than previous generations. And I think that's a point that they make too. This persistent lifestyle, renter lifestyle, or maybe interest rates and home prices are too high. They're being prevented. But I think that there's going to be a little bit of a shift, and we're still negotiating what the relationship to a home is. Is it something that you rent? Is it something that you buy? And at the bottom of page 11, I hate to run back up here. There's a graph at the bottom that shows how the number of renter households has steadily increased and keeps increasing. But the rentership rates, that is to say, the percentage of households that are renters and not homeowners, has steadily declined. Now, this kind of tracks with a lot of how much more expensive homeowners been getting. And it does represent maybe an opportunity and a growth in the renting population and increased apartment demand. But I think that also the rentership rate it's still a little bit up for grabs. And I looked at this a lot, and I tried to square with this increase in the population and decrease in rentership rate. And the best way I had of thinking about this was looking at homeownership rates. I had it on the FRED, it's like a graph from the St. Louis FRED, but it uses, I think it's census data on homeownership rate in the United States. And this is what I was trying to mention before about how the patterns of homeownership and housing, really, these are larger stories than a single pandemic swing. You see a spike on this graph of homeownership spike up right after the pandemic, but now it has gone down. And if we're going to talk about how many people rent versus own a home, right now we're about 66% own a home. But I think that we're going to get down to 65% own a home. And if you look at this graph, we are really in the wake of a huge upswing. It went all the way up to over 69% home ownership rate around 2005 and 2006.
Nice.
And now we are at 66. But really from like 1970 to 1995, home ownership rate was around 64, 65. So it's not unheard of that the swing could get, that people could change and preferences could change. I thought that we would be, that our current homeownership rate would be much lower in the wake of the great financial crisis and all of that. People selling their homes and they get underwater, so they decide we're going to rent now. But that hasn't really been the case. It dipped down, and in 2015, it was as low as 63%.
I mean,
it's back.
The millennial coming back to, they're going to stay renters, but there's also going to be, there's a lot that are buying homes.
Yeah.
And we're in peak household formation, family formation years, which drive single family investment. And the thing that Jay Parsons said is they're finding a way to do it. They're finding a way to buy a house. Even though it's difficult, people are still going to buy a house, and that dynamic is still going to play out. And we always anticipated that, but on the margins, they are renting more, and there's going to be a lot of folks that are going to be renters for longer, whether that's built to rent, so get the single family home, but you just rent it, you don't buy it. But people that most likely, people are going to still buy a home, and that makes sense why home ownership rate is going up, is it's just that millennial generation as the Gen Zs take over from there.
Yeah, I there's so much more in this report, but I really appreciated these accounts of the kind of short-term gains and long-term needs for more rental housing, especially on the lower end, and how really declining property prices and rising operating costs, they cover that actually on page 33. They, even despite all these issues, you think that maybe it will be giving renters a break. There still is affordability issues, especially on these for lower income renters. And I know we focus mostly on the market rate multifamily world, but the pressing need, and now this is your point was a little bit, and I'm maybe putting words in your mouth, was how market rate housing and new, maybe luxury housing coming into a market that could affect housing needs on the other end, right?
I think it's more of net supply. But regardless of supply, a bunch of new luxury apartments eventually can lower the rents in the B and even C class apartments.
And what I was thinking of as
in a growing market, you may still see rent growth, but it may actually will be less. And it's also a time delay of the class A today becomes the class B. And so you have more class B, but in 10 years. And so it's again, and you can't just people think of, oh, the new luxury apartment down the street, they're charging $3,000 a month. That's insane.
Yeah.
Like they're just the rent's high. Who's gonna pay that? And it gets everybody. It becomes an emotional argument. And then with the anecdote and the evidence would be like, oh, that's going to increase rents elsewhere. As the B class apartment owner is like, oh, if they're at $3,000 and I'm at $1,500, well, maybe I can charge $1,750 because I'm still going to be cheaper than them.
Yeah.
But you still have to meet that demand, and maybe you can. But that's like those two instances. But if you keep having luxury apartments come online, all of a sudden the luxury apartments are like, yeah, we actually have to lower our rents down now to $2,500.
Yeah.
And then the B class is like, oh, geez, now the $2,500 people are seeing that as a better value as my $1,750 or $2,000. Now I actually need to lower my rents a little bit.
Yeah.
So I can be the true value option for individuals. So you have to take time into account. It's not as simple, and it's not always as cut and dry either, because every market dynamic is a little bit different. But if we're talking about affordability, the more stuff you have usually is going to make it more available and more affordable.
Yeah. It's like you can't get around that for sure.
Yeah.
I was interested in the idea that even the affordability crisis or affordable apartments themselves, I think that this pressing need for affordable rental housing is not only worth mentioning due to how big the issue is, but also really it's going to impact the market rate side too. Any solution that is going to address the affordable, maybe it is building affordable housing, or maybe I don't know if it's like some onerous rent control or if it's deregulation on the other hand to make houses cheaper for people. That effort is going to bleed into the market. It's going to have some effect. Maybe it'll lead to investment opportunities.
Well, one effect that wouldn't necessarily be great for multifamily. I don't think it would be the end of the world, because housing demand is usually good housing demand. But like what happened in the 90s when you had more incentives to that incentivized home ownership, lending got a lot easier, which eventually all led to the great financial crisis. Basically saying, hey, everyone, you get a home. We're going to make financing available for everyone to be able to buy a home. No money down. The government could come up with any program they wanted to. It may be horrible for the economy in the long run, but it's not crazy to think that there may be some federal government incentive program that encourages ownership that could reduce the desirability of rental units, because if you could buy something.
I was thinking even more in a really simple, in the same logic, really. What if a kind of nice government subsidized building came up right across the street from yours? That could also have an effect. Now, I know that gets into a whole NIMBY argument, but
and they don't do it like that anymore.
Yeah,
it's not, maybe it's a subsidized. It's light tech.
So these are investors that are, or developers that are
government got out of that business in the 70s.
Okay.
So they weren't good at it. They couldn't do it. Go to the project, go to the big towers that are falling apart. That's what the attempt was.
Yeah. Well, and that looms behind your earlier discussion of the importance of kind of market rate and investment in new housing supply. It's like, it's the only way we're building housing right now.
Yeah,
so that's really interesting.
Going to happen. Yeah, no, you go to the affordable apartment community, affordable housing. They're nice. They look like luxury apartments. That's the other thing. They're building them like luxury apartment buildings. That's might as well. It doesn't cost that much more to build them. Like, you'd have to try hard to make them bad. So why would you do that? The deal down the street? That's partially.
I didn't know, and I didn't know the ins and outs of it. Yeah,
they have units that they set aside for 60% of AMI, 80% of AMI.
So if you're making 80% of the local income average, then you can qualify to rent this. It's not just like, it's not a whole apartment wherever it's conscious.
Some apartments, are fully light tech and are fully income restricted. Others are partially. There's 20% of the units. And so there's different types of tax credits. And then there's also other local incentives that you can apply for. And the city may say, we'll give you a tax abatement. You don't have to pay property taxes, but we want you to keep all of the rents affordable. Or we would like for 20 units to be at 80% of AMI or 60% of AMI or whatever income levels, because this is what the greatest need is in the city. And hey, we'll incentivize you to do this for creating this housing stock. That's been a lot more effective than the federal government or a city being like, we're going to build what we need, housing. Okay, let's build it all here. And it ends up being obvious. Well, it's still a boondoggle, but even more of a boondoggle. And then who's going to manage it? Or the government's managing it. Good luck.
And that's something that I have noticed in the conversations about housing for the past almost like a decade, is a movement away from the kind of iron hand of the government in, like, whether it's rent control or really building it themselves, but more towards deregulation across the aisle too. Whether it's Republican or Democrat, they both kind of acknowledge, all right, it's time to loosen some of the restrictions. And I think that the NIMBYism is such a difficult barrier that I think that they would have come here anyways. Like, there's always going to be someone that disagrees with new housing that's being built. And I've said this before, but I still think it's a powerful point. It's about, eventually you're going to get to a point where the government of a larger area is imposing on a government or people in a smaller area to build more housing. You're never going to.
That's happening right now.
Yeah.
The Live Local Act in Florida provides statewide incentives to build affordable housing. And it's basically the whole idea of building by right, of where I actually have a right to build this type of housing because of state law that I'm building affordable housing. I can build here. Local government, you can't say no because the state has allowed this. Now you could get challenged in court. Texas has similar legislation. It's really interesting. In Florida, it's called the Live Local Act. It gives big tax abatements to folks that provide affordable housing, keeping rents at affordable levels. And it allows apartments to be constructed again, like by right, more or less, as opposed to getting all the local checkoffs. And I don't know the details.
That's interesting, though.
But it's exactly what you said. Is sometimes you do, and then it comes down to what it's local government versus the state government, federal government. Local governance typically is best, but then what if that local government is relatively kind of authoritarian and not allowing any, basically trampling on property rights? It'd be the same thing if a local government had racist policies. They were violating civil rights, or if they were violating civil liberties or locking people up without a trial and all of that. The state government come in and say, hey, look, you can't do that. You can't just go in and pull people over for nothing and throw them in jail. You can't do that. Same thing as God, you can't, they own the land. They're building, you got to let them build the affordable housing. You can't tell them that you want a certain type of brick facade with this ornamental, take your input. But guys, you should be, and this was said at NMHC, these local authorities need to stop acting like they are regulators and see them as their job as regulators and see their job as facilitators of like, okay, you want to build? Great. These are the programs that we have. What can we do to help? As opposed to be like, oh, you want to build on that land? Well, let us tell you what we were thinking about that land in the area. And well, what's it going to look like? Not going to work for us. This is how it needs to look. These are all the things that we want to see. And again, it needs to be a partnership because you obviously, if you're the developer, you want the input of the local community to see what they want. But, some regulator, some bureaucrat isn't always that.
And it does seem like, and I'm all for locally determined government and the kind of power that resides in the individual and extends outward or whatever.
Yeah.
But there does seem to be a breakdown, and it's almost like from city to neighborhood is where this housing NIMBY breakdown happens. And it's like the housing needs of a city, those are bigger and more powerful than the distaste that you have of having an apartment.
And again, it's like, exactly. I agree with you, Matt, because it's one thing to... So it's one thing to say, it's like, hey, look, no, I own this land. Like, you can't take it and do something. But it's like, just because you live nearby the land.
Yeah, exactly.
You don't have, I don't know what collective special right you have to say yes or no. Obviously, I know that's what zoning is, but if you remotely believe in some degree of property rights, and again, I'm not saying unfettered and you can build something that's dangerous and whatever, but I'm saying within reason, like if it's gonna fit decently well in the community, just let them do it and let's get it done. And also, by the way, all the individual, this type of design and this type of facade, all that does is add cost. And all these developers at NMHC, I'll get here, we're not necessarily a developer, but all these developers, all they could talk about is like, look, all these cities, they have all these like special requests. They're like, could we try it? It's like they're picking it out for themselves. And they're like, well, we were thinking maybe a little bit of different design, and can we see the color? Oh, that's not going to work for us.
And they're not fully conversant. We're not thinking about housing needs when in those conversations.
No, they're thinking about like, this is my opportunity to like have a little bit of power and like exert it. And the result is the project gets delayed, which equals money, and whatever the changes are usually more expensive. So what does that result in? Higher rents. It's every change order that you send.
Studies that need to be done.
It's like, okay, we're increasing the rents a little bit more. We're increasing the rents a little bit more. And then they're like, well, the rents are a little bit high. And it's like, it's because we had to put this marble thing on the side of the building with whatever.
Oxblood paint or some kind of rare coloring.
Some sacrificial sacrificial
can't even get it anymore.
What are we even talking about now, Matt? Well, Matt, this was a great set of reports. Again, thanks for bearing with me as I did a data dump from NMHC. Love more to talk about the Federal Reserve and some of my notes and takeaways over time. So many reports, though, to talk about. Matt, next week, I know we've got some interesting articles, one from NYU. Again, we're talking about the different perception, what new construction looks like and what it does to rents in a market. We'll have talk
about that Marcus and Millichap.
Oh yeah, we got the new Marcus and Millichap 2024 outlook. It's always a good, you said, voluminous piece. It goes into national markets, asset classes, and individual markets, regional, individual. And again, make sure you're subscribed to the Gray Capital YouTube channel, man. That's where you're going to find all this stuff. Or make sure you're hooked up on Spotify, Apple Podcasts, wherever you're getting your podcasts. Sometimes you want to watch on video. You can see the charts and graphs. Sometimes you just want to bask in the voices of Matt and myself. However you like to consume your content, we appreciate your time. Appreciate you being here. Also, if you're a accredited investor, Gray Capital, we have a deal coming up.
Watch this space.
Wow. Stay posted. But if you'd like to be one of the first folks, again, this is only open for accredited investors. If you are one, you want to be updated when we announce this deal, which is going to be soon. It's going to go quick because there's so few deals on the market, and this is actually a good deal. It's like a really good deal. If again, you've been listening to the Gray Report, we haven't had a deal in a while. What our mindset has been, our thoughts on the market, and it's not a like This isn't a willy-nilly thing. It never is, but it's taken a long time to get here. We're really excited about it. You want to make sure you have an account on the Gray Capital investment portal. Hop on over to graycap.net. You'll see a little button that says investor sign up, new investor sign up. Click that, fill out a quick form. We'll give you access. You can start digging into due diligence materials. We're kind of probably a little too transparent. We're just, here it is. The questions we ask are like, are we allowed to share all this?
Yep.
But basically, if we got it, you've got it. You can take a look at it, schedule a meeting with anyone, member of the investment team, kind of get up to date, dropped in, ready to go, and we're going to crush a deal. Oh, by the way, Matt, 100% bonus depreciation is coming back.
Oh yeah. We got to talk about that next
week. We're going to talk about that. How bonus accelerated depreciation going back to 100%, even retroactive for 2023. Yeah. Beautiful. It's wonderful. We're excited. Also, the extension of the child tax credit. So that's going to help a lot of families as well. A lot of folks out there. It's a bipartisan bill that passed in the House. Again, we'll have details next week, as well as everything else that's changed in the multifamily market. Again, everyone was out for NMHC this week. Everyone's going to be back in the seat,
revved up,
getting it done, revved up, ready to go. This is going to be, you're not going to want to miss in. Make sure, again, you're subscribed, you've liked, you've hit the little bell icon here to make sure you're fully up to speed, up to date, locked and loaded, because this is the cycle that billions will be made.
Oh, yeah.
So get off the sidelines, get ready to go. Catch you on the next episode. Appreciate you taking a watch. Good one.